The next 5 months are going to be far from boring, both in terms of the stock market as well as the US economy. There are plenty of concerns out in the market, such as sky-high stock valuations and a terrible job market borderline on recession, but there are also counterbalancing positives, such as the US government shutdown hopefully coming to a close soon and upcoming interest rate cuts. Therefore, I think it's worth going through each of these big headlines, starting with the negatives, then going through the positives, and trying to make sense of all of this in terms of our portfolios. First up, let's talk about the jobs market in America and how it's basically been put on ice. If we look at the ADP data, this is the company that processes around 500,000 employer payrolls and has access to about 20% of all payroll data in America. Now, the ADP is telling us we are pretty much borderline in recession right now in terms of the real economy. For the past 5 months, America has been averaging about 18,000 jobs gained per month. And slowly over time, we're seeing this group of people, we can just call them the non-participants in the economy. The government really just gives up on people if you've been out of work for 6+ months. They kind of just say you're just not going to get a job, and they no longer count you as unemployed. And ever since the dot-com bubble bust around 2001, we have seen the participation rate in the economy go down, and each time we recover from some sort of crisis, we are not fully recovering or going back to those total people participating in the job market. And the trend of weak hiring doesn't seem to be getting much better if we look forward. One of the key indicators to see if we're going to get new hires is from open job advertisements. However, we're really only back to a 2019 amount of job openings in terms of a per capita basis, but we've also got the reports of about 20% of all jobs are just fake in nature and are really just there to harvest your data. This has gotten even worse in the past few months. There has been a new trend of people stealing jobs, but through a brand new technology way, and that's through creating a AI persona and trying to fake a real human being in a job interview.
It won't work when you partially occlude the face. I asked him to do it, and he knew that the filter would break, and he didn't do it. At this point, I was like 100% sure that he was trying to trick me.
So not only can you not find a job, you have the government also cutting your benefits, you still don't have universal healthcare, social welfare is maybe not dependable anymore, that's getting cut from all directions. You're also paying about 14% tariff rates on all imported products. All of those are really hurting lower to middle class people, but also small businesses. On top of all of that, you're now versing these fake personalities, maybe being created from overseas, and maybe 1 in 100 of those fake people actually take your potential job. All of that is just really taking out billions and billions of dollars from the kind of base level real economy. We can see this measured in the business optimism index. Yeah, it's recovered a little bit since 2022 and 2023, but we were in a shallow recession at that time point. We still have not recovered back to 2018's confidence levels. And if we also pair that up with the overvaluation of the stock market, we are sitting around the top 1% of all-time valuations, especially when we look at growth companies. But those growth companies deserve the higher valuations. They are benefiting from government contracts. They're benefiting from trillions of dollars in AI infrastructure spending. So it's like we have these two different but circular economies. We have these top maybe 20 tech companies in America profiting and making deals off each other. And then we've got pretty much everyone else that is on borderline recession. But going into the positives, quite a few of these haven't really been priced into the market yet. So therefore, I think we have this upward surprise in expectations for really the next 5 months. First up, we have the Fed cutting interest rates over the next year. The Fed funds rate is technically the interest rate of one-day or overnight loans. Think of this as the minimum interest rate in the economy when we price in no risk. Now, if we cut this interest rate over time, hopefully that pressures down the economy or sends out a signal to bankers and those that lend, we want a lower interest rate policy throughout the country. There's no guarantee this works, but when paired with lower inflation, this is a powerful economic stimulus to, yes, the economy, but also a nice boon, a positive for the stock market. So we do need to go through the inflation story to confirm if this is truly going to be a benefit, or is this just going to be a talking point people forget about in a few weeks. So overall, we're sitting at an inflation rate of 3% in terms of a yearly change. Now, they reckon about 0.5% of that 3 is coming from tariffs. So we should truly be at a 2.5%. But if we also take into account 1/3 of inflation comes from housing, we've got these stories from pretty much all over America that rents may not be decreasing, in some places they are, but at least they're growing slower and slower. So taking that picture of lower rents over time or slower growth, as well as tariffs being a once-off, moving forward in about maybe 6 to 12 months, we're looking at inflation being below 2%, which again confirms to us, yeah, the Fed wants to keep cutting rates, and the probability of more rate cuts happening will just keep increasing over time. And the way we see this play out is through the valuations that people are willing to pay for certain companies. So whichever name that you're talking about, let's just take the average of the stock market, forward P ratio around 22, maybe with all of these positives about interest rates and lower inflation, maybe we can see more of a forward PE of a 24. And that does not take into account the already cheap names that are out there in the market. For example, assuming a 20% earnings growth rate for Meta, we have a forward P ratio around a 17, extremely cheap for a company growing profit probably in the range of 20 to 30% per year. The inflation and interest rate story is just one more piece of the puzzle convincing investors to pay more for these investments. The story of lower inflation and lower interest rates can be extremely positive for the stock market, especially when we compare this with a story of around $2.2 trillion worth of retail money, so that's money from people like you and me, sitting in money market funds. Money market funds effectively just put your money straight into very short-term treasuries, paying out pretty much whatever the Fed funds rate is. So it's paying out roughly 3.8, 3.9%. There is a direct correlation between the Fed funds rate and the amount of money that flows into these funds. So given that interest rates are coming down over the next year, that's pretty much confirmed. That means at worst, we could have a pause in these money market fund growth. And at best, we could see $500 billion flow back into the stock market and really spur on a huge last ramp up in stock prices before maybe we see a recession coming in 2026 or 2027. Let's move on to more of how the government itself is going to impact the economy and the stock market. First up, we have some progress in the government shutdown finally getting alleviated. It's currently the longest ongoing one in history, but we have had the Senate Democrats agree to put their differences aside with Republicans, and put very simply, it seems like both sides have agreed to kick the can down the road for a lot of issues, deal with them later, and they've put this bill up for the House to vote on very shortly. If the Democrats in the House agree to pass this bill, then we are going to see 700,000 federal workers get their paychecks once again, but they're also going to get back paid for all of those payments missed. So this positive news is more about avoiding a bigger negative, but this is also a signal that means risk on for the stock market. All of a sudden, when we have these positive news headlines, these names are up 8% in a single day. Those are very good signs of a bounce back in the market, and we could go back to maybe taking out all-time highs. Continuing on with the positives from the government, and in this case, Trump himself.
One of the things we're going to do, we're going to issue a dividend to our middle income people and lower income people of about $2,000. And we're going to use the remaining tariffs to lower our debt. We're going to be lowering our debt, which is a national security thing. So we're doing a lot of good work. And the numbers were reported so incorrectly. The real numbers are trillions of dollars have been taken in or gotten in terms of investment from the tariffs.
Now, I'm kind of going to fact check this and say that this is fake news here, that we don't really have the trillions of dollars in tariffs coming in. The money is more in line with around a few $100 billion coming in each year. The broader administration has earmarked this money more to help pay down the debt and maybe also make up for the economic growth loss that we could have seen for the US economy if we did not have tariffs. So in this case, I see this story as a nothing burger. It's not really going to happen, and the stock market is not going to cling to this news and see it as a reason to move up higher. And that brings us to the last piece of good news today, which is about the Christmas rally over the next few months, but it could extend until about mid-April next year. We are sitting in a very unique place right now. We've just come off a lot of high quality companies selling off 20-30%. Think of your high growth tech names like Meta. You've also had Oracle that's fallen off 25 something percent. There's also high growth, but maybe less quality names like Celsius and Duolingo. They have sold off recently as well, but also really high quality dividend companies like Southern Electrical Utility and also Pepsi. A huge amount of names to pick from, and they've sold off just in time for probably one of the better time periods to buy stocks in the whole 4-year election cycle. But we also see that continue going through to around April in a midterm election year. That's not just a small piece of data there, that's the average performance of the S&P 500 going back the last 90 years. There's been plenty of wins lately for Democrats, showing a bit of positive momentum there for them, and maybe that also means a positive for us in terms of the stock market. Generally throughout history, a bit of a balanced Congress versus president setup does the best for stocks, and that spells out more economic stability for America, and stocks generally perform better under those conditions. I do believe this paints a picture that we need to make the most of these short-term sell-offs we've seen in some of our favorite companies. That's why I've gone super heavy in my favorite names like Meta, and surprisingly, I quite like the name Celsius for a company with a lot of revenue growth, maybe around 20-30% moving forward each year, but has a forward P ratio, maybe somewhere around a 25. I think this is a great time to buy some high quality names, buy growth companies that have sold off, ride them for the next 5 months, where Meta could go up 40% during that time, and just get back to a more appropriate valuation.